Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
My old stomping grounds, Evan. Upstate New York, Albany, New York.
Yeah.
There was this mall that we used to go to when I was a kid. Kid? Teenager. Probably teenager. Crossgates Mall.
Anything under 60 is a kid now.
It really is. It made the Wall Street Journal.
Cool.
Crossgates Mall made the Wall Street Journal. This is, I grew up around Albany.
Wait a minute.
Come on, will he get it? Will he get it? Yes.
They're like worried about going into default. There's a
There you go.
corporation.
Nailed it.
Yeah.
Nailed it. Yes.
Yeah.
Carl Icahn.
Yes. I have that article.
Do you have that article? Did you really? That's fun. That's funny. Well, what did you? So the idea, those of you that don't know, real estate investment trust, big hot investment item about 10 years ago. I guess there were people trying to sell this stuff like crazy, trying to sell it like hotcakes, and the brokers, advisors, and good commissions on them.
Yeah.
And one of the things that I did 20-something years ago is I used to sit in workshops for limited partnerships, real estate limited partnerships, and these types of things. And I couldn't get my head wrapped around whether it was a really good idea, but it was brilliant the way this one guy used to market them. He'd be like, okay, we're going to do this. We're going to put this amount of money in a real estate investment trust or a limited partnership or something like that. And it's going to kick off income. And here's how much it's going to kick off, 8, 9%, whatever. It was a really high interest rate, for the time. This is 20 years ago. I mean,
yield.
That was like, yes, yield. Thank you. Thank you. I've been schooled. Yes, you're correct, yield.
Yeah.
So anyway, because you're getting paid rent, you're not getting paid interest. Okay. So anyway, the thing that you were concerned about, of course, as an investor, is that you would have to pay taxes on that yield.
Correct. Yeah.
And then you say, well, what are we going to do about that? Well, we're going to have an oil and gas limited partnership. And the oil and gas limited partnership, we need fuel. So what we're going to do is we're going to buy this and you're going to get tax credits for investing this type of stuff. And the tax credits that you get for investing in these partnerships are going to offset the interest that you're going to get from.
Right.
And, if you listen to it from a financial planning standpoint,
it sounds like a win-win-win, right?
Wow. Yeah, man.
What's not to like?
Yeah, what's not to like about that?
I'm making money and hosting the government at the same time.
Sure. So you have that. And then what you would do, this one guy would teach, you would take the yield from the real estate investment trust and you would buy variable life insurance with it.
Oh, no, that's a new twist. Okay.
So what that basically is, for those of you
you'd
who
use
don't
those distributions to pay the premium on your life.
That's correct.
Whoa.
That's correct.
That's pretty creative.
Oh, it was very creative. And then what would happen is then, of course, part of your premium goes to pay for life insurance. But when you're young, it's extremely low cost.
Right.
Because it's term insurance. Typically, though, in those variable products, the term insurance was overpriced. It really got down to it. And I remember asking the question, why is it so stinking expensive? The insurance in these, and one person explained it to me. He says, we have so much in terms of having to deal with securities regulation and that they have to charge more just to make ends meet.
I would actually believe that.
It just made some sense. It did. It made some sense to me. So, then what happens is anything above the cost of the term insurance, you would be putting money into basically glorified mutual funds.
Right.
And then they wouldn't be taxed. And then what would happen is as time goes on, you go to withdraw money and your money comes out last in, first out. So whatever your gains were, that comes out. First in, first out. I said that I was thinking in terms of annuities. It's the opposite. It's the opposite of annuities.
Oh, must have been an older strategy if it was first in, first out.
Well, so with life insurance, what happens? I'm talking about the life insurance here.
Yeah.
So what happens is you get your premiums back first. So so what ends up happening, that comes out tax free. Then what happens is you get to the gains. And when you get to the gains, if you just yank them out, you have to pay taxes on it. If you're under 59.5, you can have penalties
At
along
ordinary
with that.
income rates.
At ordinary
not
income
capital gains rates.
That's right.
Yeah.
So the higher rates of the different types of rates you can have from a tax perspective. So what you would do instead is you would actually borrow the money. And you would borrow the money, and then some of the more creative contracts did what were called wash loans. So a wash loan is they're going to charge you 6% to borrow your money, and then they would credit back 6 as if your money were still there. And you go, well, why would they do that? Well, it was a tax thing, so they could get away with this because technically what they considered it, rightly so, was that it was an advance on the death benefit. Now, life insurance death benefits are tax-free. So when you put money into a life insurance policy and you get a death benefit, there is no tax on that death benefit payout. And same for term insurance or any type of life insurance. So since it was in advance, you're actually part of your death benefit. Now, this is sometimes improperly taught. Some people, what they'll say is, oh, well, with life insurance, what happens is you get the cash value and the insurance company keeps your cash value when you die. That's just wrong. And I won't say who teaches that. It doesn't really matter. It's been very widely taught by a lot of different people. So let's say you have a $500,000 life insurance policy and you have built up cash value, which is your premium payments that were not used for life insurance costs, but went into the savings aspect, plus the returns that they earned being in whatever investments they earned. Let's say that grew to $200,000. And you had an option A death benefit.
There we go.
Now, here's what happens is when you die, your heirs get the $500,000. They are technically getting that $200,000 back plus $300,000 of pure life insurance. If you had an option B benefit, what would happen is they would get the $500,000 plus the $200,000. So it really depended upon you. Sometimes they call that option 1 and option 2. It just depends on the company.
Right.
So what happens is technically you go, well, why would I ever want option A? Because what happens is you get older, you're buying less insurance. You're buying when you were young, bought $500,000 worth of life insurance coverage, and that was the premium. Later on, you're only paying for $300,000 because your $200,000 is just the return of the excess premiums you paid.
And when you're doing that at an older age, those rates are basically calculated monthly. Mm-hmm. The cost of the insurance is calculated monthly. Mm-hmm. Well, if you're 55, the cost of insurance on $300,000 of remaining, coverage still probably costs more than when you were paying for insurance on $500,000 at 25 years old.
Yeah, precisely.
And it's just a cost saving, cost management tool.
Yeah. So in this particular case, let's just run with these numbers. If I get down to retirement, I start pulling out this $200,000, and let's say that only 50 of it was premiums paid. So I pull out the 50, and then I got the 150. If I want to get at that without taxes, I have to borrow it out. And they charge you 6, my example that I'm using, and then they credit 6. And you go, well, why the heck are they doing that? It's because you get that back. It's an advance on the death benefit because you're going to get that $200,000 back one way or another, whether it's the 200 plus 300 deal or the 500 plus the 200 deal in the 2 examples that I gave. So now what happens is that you pull out too much money, and the cost of insurance is now you're getting old. Now you're pulling out the dough out of that right. portfolio, and you're paying for $500,000 of insurance, and you're 80 years old. Just imagine what that cost is because they're raising that premium. They don't care how long you've been in that contract. They have a contract schedule premium that goes up every single year as you age for every $100,000. Every month, sure, for every $100,000. Well, technically, it's done on a year-by-year basis, but it's month by month. It does go up because the amount of insurance changes.
Right.
But technically, the premium is set yearly. So they call it YRT sometimes, yearly renewable term. So what happens is all of a sudden you're going, oh, crud, I can't afford this premium anymore. And then the company says, we don't care. You got to pay the premium. And you have run the cash down to nothing. And then you now have a situation where you have a lapse. So let's say you have this policy lapse, and then all of a sudden they go, the government goes, yeah, that was a nice trick you were trying to play on us all these years. But you know what? You owe taxes on $150,000 gain. You paid $50 in premiums, and you had that $150 of gain. Just keep it simple. Let's just say that it's still that amount when you do this. Now you owe taxes on $150,000. Well, you'd think, that after all these years, people would be wise to this and they wouldn't be even trying this little trick anymore. No, they're still trying it. It's still out there in droves. People are trying to sell this type of an arrangement. But it was real creative. You go, hey, let's do this thing with real estate investment trust. And,
Do you remember the acronym that they used to use for that? Not with the life strategy, but do you remember the acronym that kind of made its way around to
LEAP?
Pig Pal.
Pig Pal. No, I knew LEAP, which was it was supposed to be Lifetime Economic Appreciation Program,
on
but
the REIT side.
Oh no, I don't know.
So
Pig Pal.
They called it Pig Pal, and so the pig stood for passive income generator.
Oh, okay.
And so that was your real estate investment trust, or when it was legal and all that kind of stuff, limited partnership. Well, active losses can't offset passive income. And so that's when you clicked in either tax credits for low-income housing and that kind of stuff. There was packaged investments that you could invest in low-income housing, and it threw off.
That was big. We did that too. Yeah.
And so you had the PAL was passive activity losses.
Yeah.
And all these things sound really cool, right? And you're like the hip person at the club or the water cooler, I'm doing this Pig Pal thing and passive this. But they were illiquid. And if, interest rates shifted like we're seeing now, all of a sudden you didn't have as much passive income to offset. And you're like, I just want the income. And I'm not even worried about the taxes.
I know.
They went away because you lost your income.
I'm broke, but I'm not paying any taxes.
So, there's no shortage of... The investment community is probably close to the military in terms of creative acronyms for stuff. It's really crazy.
Well, you remember the low income housing? I remember the brochures.
Absolutely.
I was just going to say, do you remember how nice some of those places were?
Oh yeah,
I remember the brochures. I was like, I want to live there.
They look like a condo in Orlando off near SeaWorld or something.
Oh yeah, it was beautiful stuff. And I thought, seriously, this is low income.
I sold that stuff.
Did you?
Oh yeah.
I was
back when I was on the dark side, not for the last 25 years.
No, I get that. I was low confidence. I was a low confidence advisor. Yeah. It was, if I didn't get it, it was just, I can't get myself to sell. Like I didn't trust it.
Yep.
But it was because I just didn't understand it well enough. I mean, if you asked my management, they were saying, Paul, you just need to get out there and sell this stuff because it's really good. Just trust us. And I was like, going, I don't trust anything.
Yeah, that's what 40 years in this business will do for you.
Yeah.
Or 35, whatever it is, I think that's important. I think that's important to touch on.
Yeah.
It sounded like a really good, sound strategy. What's not to like? I'm generating this. I can offset the taxes. And, it's a great story to tell. But after several years in this business, you realized why there's an inch-thick prospectus that accompanied that real estate investment trust or it's because the devil is in the details. Yeah. And if anything goes wrong, the investor is going to be the one left holding the bag.
Yeah. Yeah. You don't have much recourse.
No.
Because it's in there. And I will never forget one time I had a situation like that where guy was invested in something, and it was these concrete houses that were hurricane proof in Florida.
Oh wow!
They could probably use those right now because the insurance rates are going way the heck up down there. But yeah, so it sounded really, really good. And then what happened? The guy lost. He said that he had lost $350,000.
Oh wow!
First.
Okay,
it was like $350,000, and we brought in a securities attorney, buddy of mine, to talk to him. And we're blabbing back and forth. And the whole time we're blabbing back and forth that the guy doesn't have a case, he slips a note to, Jonathan and myself. And he slips it more to Jonathan, then Jonathan slips it over to me, and it basically said, we lost twice that. I just don't have the heart to tell my wife. Yeah.
I remember that.
Yeah. It was, brutal. So, one of those things that, in the course of the conversation is like, why doesn't he have a case? Why doesn't he have a case? And the attorney just goes, it was all disclosed. It was all disclosed.
Yeah.
The risks were disclosed. You have no case. And that was a wake-up call. So the Carl Icahn thing.
Yeah, so we swerved onto that.
Well, let's come back to it in a second.
Totally.
Let's come back to it again because
it's a good story.
It is very instructive.
That's exactly what I was going to say.
Were you saying?
Instructive.
It is very instructive. So just
scary.
Hang on. Yeah, it is scary. We've been hanging out too long. You're listening to the Investor Coaching Show. Paul Winkler along with Evan Barner. We'll be back right after this. Stay tuned. Thanks for tuning in to the Investor Coaching Podcast. Now, you may be one of these people that's been listening and realizing, wow, investing, there's a lot more to it than meets the eye, and financial planning, tax laws constantly changing, and recognizing that maybe you might need some help in this area, but you don't want just anybody to help you out. So we have 10 offices in the Middle Tennessee area, and everything that we do is fee only. We align our interests with your interests. So you can get an initial 15-minute phone call with any one of our offices just by going to paulwinkler.com/call. That's it. Every one of the offices is run by somebody with 20 plus years experience. They're all degree planners. They all have academic backgrounds in investing, and you can get the help that you need. So if you want to set up a complimentary phone consultation, just go to paulwinkler.com/call. And we look forward to seeing you soon. So Carl Icahn, let's get back to Crossgates Mall. I grew up in upstate New York around Albany region, and we had a mall that we'd go to. We had a few of them in Albany that we would go to. One was that we would go to quite often was Crossgates. And I was shocked when I read the Wall Street Journal this morning, and it was talking about Carl Icahn and how The Big Short, Big Short was a movie that was talking about how these guys shorted the market back in 08. And basically, it was like time was not looking good for them. It wasn't on their side at first, and then they just looked at it at the end. So, the market dropped at a time just before they would have lost everything. So, watch out shorting the market. It's pretty dangerous territory. But Icahn says, now that he's lost a ton of money, the game was rigged. That was rigged. And so often we hear that the stock market is rigged. It's a gambling casino. And, it's typically the way I answer that is, yeah, it is a gambling casino the way most of you and the fund companies actually approach it. But, what was your takeaway on that whole thing? Because it was interesting regarding the loans.
Yeah, what I took from the article was not so much the mechanics of it on the technical side.
It was very technical.
But looking at both his protege that had been betting against shopping malls for 3 years, starting in 2017, which would be pre-COVID, which to me is
it's very interesting.
Of this story.
Yeah, because it wasn't like you were betting against it once.
Right.
They shut
so
down.
they were seeing Amazon or whatever.
Mm-hmm.
And he made some money and lost some money and ended up getting out.
Mm-hmm.
Carl Icahn then goes short, meaning betting against malls surviving during COVID.
Yes, and the issue being the debt, that they had.
Well,
that they
the
were
debt
taking on.
and, people aren't going, and so they can't service the debt. They're going to go under and so forth.
Mm-hmm.
And what struck me was, and now this is perception. So this is, I don't know, maybe not familiarity bias. You can correct me on what I'm using back here, track record maybe. But Carl Icahn is not a stupid person, okay?
Right.
And what I took away from this is it's not, Madoff wasn't a stupid person either. He was a crook, but a very smart crook.
Mm-hmm.
And Icahn, I don't think is a crook. You don't misunderstand. But, when you see these people like, oh, well, they're a billionaire. They must know something I don't know. I've got to get in on this thing. I don't have access to enough information to pull this strategy off. Trust me, this guy's got access to whatever information he wants.
Yes.
The bottom line is he made a big bet on a throw of the dice, and he didn't get double sixes, And that was really the big thing that I took from the story is there is no amount of money, there's no amount of intellect that is going to give you the ability to consistently predict the future and so forth. Now, he can maybe withstand a loss of $700 million, but if all you have is $1 million and you're getting ready to retire and you lose $700,000, that is a life-changing mistake. That's really what I took away, not even so much what the loans were used for and so forth.
Yeah, and in this particular case, you look at it and everything in his eyes seemed like it was a slam dunk.
Looked reasonable, absolutely.
Until somebody comes in and pays an amount for the debt because they bought the debt is what it is. So let's say that you had a mortgage and, you've seen this happen, folks, where you take out a mortgage and it gets sold. And now you have somebody else servicing
your house.
Yeah, and then you have somebody else servicing the mortgage. And the reason that happens so often is that banks don't want to be on the hook for your loan for 30 years. They want their money in motion. They don't want many times just sitting there receiving payments from you. They want to be doing something else with the money. So what they'll do is they will make money on setting up the loan, putting it in place, then they sell it to somebody else. They've made their money and they walk out the door. And then what happens is you'll have quite often the end investor. And this is something that happens often is where these things are securitized. In other words, they are turned into a mutual fund or something like that. They're turned into something where the public has to go and, they don't have to, but they go and buy these things and they end up with Fannie Mae's and Ginnie Mae's. And
collateral mortgage obligations.
Yeah. And then you end up owning this debt on somebody's house and now you're the one receiving rights to those payments. And the problem that you run into is that the duration on these things can be like really, really long. Can think of Silicon Valley Bank, when all of a sudden now they have loans that are out there that they're not going to come due for a long period of time.
Yeah.
And when interest rates go up, they come crashing down.
And they weren't even in a risky investment, quote unquote, in general sense. I mean, they were in government bonds.
Right. Exactly.
But they were such long term that they couldn't support the payments.
And these banks
or the
don't
reserve
tell
requirements.
you that they're switching over or handing it over?
It doesn't matter. Yeah, they do tell you. You'll get word from in the mail or you'll get something like that, and then they'll say, hey, you're having this thing, somebody else taking over your mortgage for you, and then you're basically paying somebody else, even though you set up the mortgage someplace else. But it's in this particular case, it was just bad circumstances, and of course, what he says is it's rigged. The situation is rigged. And here's why, look at it and go, are there ever cases where you could make a point that something is rigged? Yeah, you can, I suppose. You could say that somebody kind of rigs it against you because you can think about the GameStop thing.
Right.
It was sort of rigged. You had a bunch of small investors that were willing, I don't know if they were really setting out to lose money in the beginning when they were buying that stock.
To lose money.
I don't know. It's just like you look at it and go, what were they thinking paying that much for that stock? But what they were doing is they were trying to drive it up and drive it up and drive it up. Well, a short sellers is really counting that stock dropping so that they can rebuy it at a lower price. But they kept pushing it up. And then what happened is by the time the short sell and they had to cover the short, as they call it, they were sunk. I mean, they were up a creek with no paddle because they had to buy back the stock because they had borrowed it and they have to go and give it back. It's like, I use the example often of borrowing your neighbor's lawnmower. And you borrow it until he's got to cut his grass again. and you got a time limit for this thing to find a replacement for this lawnmower. Because what you're doing is you're hoping that you sell his lawnmower at $800, let's say, and you hope you can buy one that looks exactly like it for $400.
Before his grass gets too tall.
Before his grass gets too tall.
Right.
I'm really butchering this one, but it's a good analogy, good metaphor. And he said, anyway, what happens is that it just didn't happen in time for him, and then you got to cover your short, and you're sunk, man. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.